Now, one of the big issues driving stocks right now is just when will the Federal Reserve start to taper QE3? And once they do, will we see a significant fall of the market? To answer this and much more, Michael Knox from RBS Morgans joins me from our Brisbane studio. How are you, Mike?
Thank you for giving me the easy questions, Peter.
Yes, I thought they were easy ones. I've got a whole pile of them, as you well know. Okay, first one, taper. What do you think is going to happen when they do?
Well, the first thing is I think they'll taper later than people think. And the reason is that when you look at what they're doing, $85 billion a month is over touch over $1 trillion a year, almost like real money, Peter. And that's just under 10% of the US money supply. The US M2 money supply is $10.7 trillion. But for increasing the money supply, for buying assets which are almost 10% of the money supply, they're only increasing the M2 money supply in the last year by about 6.9%. So the first thing that the impression I get when I look at these numbers is that a lot of the assets they're buying, they're actually borrowing back from foreigners rather than domestically. The second thing is that if you look at what the economy would be like if they weren't doing it, and we have an enormous fiscal contraction this year. The US budget deficit has fallen from 7% of GDP last year to 4% this year, 3% of GDP down in terms of the reduction of the budget deficit in 1 year, enormous fiscal contraction. The US economy is only growing at about 1.6, 1.7% right now. So, and inflation, even core inflation of the CPI inflation is only about 1.7%. The personal consumption deflator, which is what they judge, they say has to be higher than 2%. I'm guessing would be now when the next comes out is about 1.3 or 1.4. So I think what's going to happen is they're not going to be easing until next year. But what they've said is they will gradually reduce their purchases as we go month by month after that. And they won't sell them into the market, they'll hold them until maturity. So as long as they wait until the economy has recovered from the very tight fiscal position that we've got this year, and we're into next year when the economy might be growing about 2.8%, you've got a recovery in earnings next year. That recovery in earnings might be able to absorb the reduction in support from quantitative easing. If they do it before that, I think we might have some trouble, Peter.
Okay, so you're not worried about this all ending in tears. I've heard Joe Hockey, when I interviewed him last Friday, he's worried that we might get enormous inflation out of this. And I know Mark Carnegie, who I think is a very wise investor, he worries about this money supply expansion. Eventually it could end in tears. Do you think we could get away without having to use Kleenex in the next few years, Mike?
Well, like I say, even though they're buying an amount of assets equal to almost 10% of the money supply, in fact, the total money supply growth, even with all that, is only 6.9%. So that doesn't tell you that there's any inflationary problem out there. I think what people aren't understanding is that we're in this situation of extreme tightening of monetary policy, which is enormously deflationary. And if it wasn't for what the Fed was doing, we'd be in recession right now, or the US would be in recession right now, and then you would have real problems in the stock market. It's what the Fed is doing, which is keeping us out of a major correction and a major recession.
Well, when I get a curmudgeonly, middle-aged economist like you being positive on this whole money supply thing, it makes me feel like saying yahoo. So let's move on. So you're not expecting a big correction when taper starts?
Well, many people have been talking about the possibility of a 10% correction. And I look back in the data of the S&P 500 back to 1928 in my way, Peter, as you would know.
Yes.
Today, and on the face of it, 10% corrections are pretty common, and in the full period back to 1928, since Standard & Poor's have been publishing the Standard & Poor's 500, on average you'd have a 10% correction every 7 quarters, which means that we had one last year, so we should have one next year. But when you actually look at the data, most of those 10% corrections are in bear markets rather obviously. And if you look at major bull markets like we've got now, say if you look at the 1990s bull market, between 1994 and 2000, when there was the tech bull market, almost 6 years of bull market, there was only one 10% correction. So when you get into bull markets with low volatility like we've got now, major corrections like people are frightened of are infrequent. The real question is, how long is the bull market going to last? And I thought that was the next question you might ask me, Peter.
Yes, exactly. So you're reading my mind all the way from Brisbane. So you've already said we're in a bull market. Great, you've answered that question. But how long do bull markets last on average? But also give us the range, the shortest and the longest. Can you do that?
Yeah, it's really good. Again, if you look at back in the data, back to 1928, you've got to start, of course, in October 1929 with a bear market. So there's 21 bear markets and 20 bull markets. There's one more bear market than bull markets in that period. And the bear market you start with is, of course, the Depression, and that's 41 months long, and that's the biggest bear market, longest bear market you get in the entire period. If you look at the average of the 21 bear markets, on average they're about 16 months long. The median is a little bit shorter than that. Bull markets, they're on average about 31 months long, and the median is a little bit shorter than that. And of course we've been in this bull market for longer than 31 months, so we're already longer than average. But what you realise when you actually look at the data is it's kind of like Black Swan, that book in which Taleb wrote that financial economists have been trying to pretend that the whole world is normally distributed, and it's not. And the data for the length of bull markets and the length of bear markets isn't vaguely like a normal distribution. It's got a really long tail. So the maximum bull market, by my count, was almost 6 years long, and that was a bull market at the end of the tech boom between 1994 and 2000. And the shortest bull market was way back in the Great Depression. There was a rally in 1934, which was about 9 months long. And if you look at bear markets on the other side, there was a really, as I've said, the longest bear market was in the Great Depression. The shortest was a correction in 1994. Again, surrounded by major bull markets on either side. So the question is, how long can this last? Well, I think this data about the length of bull markets isn't really a really good guide. Like I say, I think that if it wasn't for what the Fed was doing, we'd already be in a bear market now, already having a correction, and the US would be in recession. But the Fed is doing this. And how long can the Fed keep doing it, keep holding up the market like this? Well, the Fed tells us that they anticipate they'll be increasing the Fed funds rate sometime in around about 2015. And if you add that to the length of the bull market we've had already, that makes for a bull market of about 6 years, which is kind of what we had in the tech boom. So I reckon that the S&P 500 has got another couple of years of bull market in it, and it will equal what happened in the tech boom, but only because of the enormous work that the Fed has done to support the market.
So, Michael, is the most important thing we look for then, given the fact that you're saying it's quite an unusual period, a very unusual period, what the Fed's doing, but it's just not the Fed as well. We've now got the ECB doing it as well. And of course the POMs are doing it, the Bank of England. So as long as the economic data is still pointing up and getting better and better, then are you less inclined to believe that the bull market is going to end soon?
Well, in all of those economies you've just mentioned, there's excess capacity. There's even excess capacity in Australia because unemployment's going up in Australia too. So monetary policy should remain expansive until you take up all that excess capacity which was built up in the US by the banking crisis there and in Europe by the additional banking crisis which they inflicted on themselves through the euro. So they've had two banking crises in one, and maybe their expansion could be longer. And in Japan we can see that the expansion they have to have has to go on for at least 5 years because that's the length of their fiscal tightening. And in Australia we've just realised that the only way we can expand this economy is by cutting interest rates. So I think what we've got is worldwide cheap money, and I think that cheap money has to go on for at least a couple of more years to absorb all the unemployment, and as long as that happens, stock markets will continue to be stronger, Mike. Peter.
Okay. So I guess we summarise it this way, Michael. It's a big bull market. You can take that bull any way you like.
It is certainly a major bull market, equal to the longest we have seen before.
All right, mate. Thanks for joining us. You explained it brilliantly. See you in a couple of weeks' time.
Thanks, Peter.